Good evening and welcome. Welcome one more week to Valley School and to our event, the event that we hold every single week to talk about personal finance and conscious investment. Today we have an event with an asset manager. Today we have what we call here in-house the manager event. Before I switch into English, I'm going to address some words to those people who are at home and connected on the internet and those who are present here in the venue. All of our events are published on YouTube. You can follow us on our social media, Twitter, Facebook, and so on. We will publish this event, we'll post it shortly after we conclude the meeting. And I've been asked to deliver some announcement for our followers. Those who already know about investment, the Austrian School in Personal Finance, we have just created a space in our blog for them to submit articles. Please get in contact with us. We have received some contributions, but as we say in English, everybody's welcome. You're more than welcome to share your thoughts if you have something to say about this. And the hashtag for tonight is hashtag Anderson VS, just in case you want to submit your questions to us. Hashtag Sanderson VS. Afterwards, we are going to switch into English. So if you want to ask your questions, you can do it in English or Spanish, because I will be able to translate your words. If you're connected over the internet, you will be able to hear the interpretation into Spanish. That will be delivered by Anna, our wonderful interpreter.
Thank you. Thank you. Good evening and welcome. Welcome everyone to your weekly date with the principles of responsible personal finance and sound investing. Our guest tonight is Tim Sanderson, and I will just briefly say a few words about Tim to introduce him to the audience in the room and to those who are watching this being streamed live from the comfort of their homes. Tim Sanderson established Sanderson Asset Management, which, by the way, manages $13 billion of non-US equities, primarily for US institutions, foundations, endowments, pension funds, religious and healthcare organizations, etc. He established Sanderson Asset Management in October 2000, and it is Chairman and Chief Investment Officer. Prior to that, he worked at Delaware International Advisors in London, where he was the Director of Research from 1993 to 1997, and later became Chief Investment Officer in Equities. He joined Hill Samuel Investment Management in 1979, and from 1986 to 1990 worked at Hill Samuel Investment Advisors, which offered international equity services to US investors. Tim is a member of the CFA Institute and a graduate of University College in Oxford, where he read modern history. He serves on the board of various UK philanthropic and academic institutions. Tim Sanderson, welcome.
Thank you.
Thank you for being here tonight. You and I have corresponded for quite a bit, trying to agree on a selection of topics, and you were very kind enough. He was kind enough to send me an outline. It's a two-part outline. Most people, in my experience, has been the most fund managers who come to Value School, usually, they want to talk about their philosophy and their approach to investing. It came as a surprise to me that even though you will speak on those topics later on, you suggested, Tim, that we begin by talking about the firm, the independent asset management firm. We have prepared a set of slides, just a couple of them, and we will use this as a visual table of contents, and that's the first part of the talk tonight. Let me ask you, Tim, why do you choose? Why do you want to start your presentation today speaking about how to manage and set up an independent asset management firm?
Well, I think it's sort of it just provides us of architecture that for the investment philosophy, etc., that you're going to try to deliver, as you mentioned. But I think one needs to consider that architecture sort of very carefully, and it's quite difficult because the firm itself can go through quite a rapid transition, maybe initially being small to then medium sized, then possibly quite large. But you need to be able to have an architecture really that will fit all of those sort of eventualities.
All right. Okay. So you first mentioned ownership as one of the first item on the list.
Yes. Well, that's obviously a pivotal one, and I mean ourselves. I mean, I can talk about our own sort of experience, and then later in Q&A, you're very welcome to sort of question that. But because we're not perfect, but in terms of ownership, as you mentioned already, we do believe in an independent ownership structure. We found that our clients are generally happy with that, or most of them. And we think of the firm actually, whilst independently owned, it's also sort of a partnership, and it's that I don't know if you have that concept in Spain, but we have.
I mean the alignment of interests.
Well, it's more a legal concept so in Britain, things like legal firms, architectural practices, those sort of things are often defined as partnerships, which implies that it's a sort of a group of people working together in a sort of common interest. I mean, what we did, so in terms of our ownership, we actually started by controlling 51% of the capital in the business, and then we brought in an outside party who are called Silchester, you may know, who acquired a 49% minority interest, and they provided us with certain faculties or certain skills at the beginning that helped us, like they helped us with our compliance and operational side of the business. But over time we took those on ourselves, but that was all sort of part of their initial investment with us. But I'll talk in a moment later on about how we split our profits, because it's actually different to that 51-49, and that's kind of important. But whilst I'm talking about this independent model, and I believe that's a model of COBAS, I mean, one should be aware there are obviously other ownership structures. I mean, often fund management firms in Britain have, and indeed still are, part of large investment organisations. Personally, that wasn't what we wanted. In fact, you read out my background, and I'd actually worked in sort of larger firms that were owned by other groups, and I found it, for various reasons, sort of unsatisfactorily eventually. And then, I mean, also another model, it's become a bit more frequent, is whilst you can still be independent, you can go for a public offering of your stock. For example, I don't know if you know a chap called Mark Coombs, who's done it for a group called Ashmore. They do sort of fixed income, but it is he's gone this sort of public route. So I think he felt that it was particularly useful because it then gives the equity of the group a sort of an outside, quote unquote, real sort of valuation, which can be used. But nowadays, if you become a public company in the UK, there's a tremendous amount of sort of administration and, you know, reporting functions that come with it. So, you know, that wasn't the model we went for. Can I just talk on those profit shares?
Of course.
Because I mentioned that, and the way you have to really decide this at the beginning of the firm is, you know, how are you going to allocate your profits? And we think of it as an allocation that's between the employees working in the business and then the providers of capital. In other words, the people who own the shares and subscribe money for those shares. And we have we decided that split would be 60% to employees and 40% to shareholders. And there isn't actually a great, I'm afraid, philosophical reason for that. It just seemed to us roughly a fair division. And just touching on the Silchester share, you know, which I mentioned, they own 49% of the stock, but because they own half of our shares roughly, that means they get half of that 40% pot. So in effect, and myself and my colleagues who own the other 50% of the shares, we get 20 of that pot plus 60 of employees. So essentially it's 80% to people working in the business and 20% to our other external shareholders. We've all sort of bought into that ownership model. I mean, I think one reason what we found useful actually is this is something that will happen with most firms that are certainly startup firms, is that you'll find that the initial owners of the stock, and in our case that was me and 4 or 5 of my colleagues, and we actually own a disproportionate amount of the stock. And the way we can sort of counteract that, if you like, when we hire good people later on who cannot or that there are not shares available for them to buy, we can actually remunerate them through that 60% of is a sort of a form of bonus, you know, to sort of balance out the fact that people with stock are getting more. So, you know, but that may not be an ideal long-term solution, but it certainly we have the sort of flexibility to do that. Can I talk?
Next up on the list, you would like to. Oh, size.
We'll now talk about size is very important
Does fund size matter then?
Yeah, I think it's very important, and this is an issue that maybe people don't think about enough, perhaps when they set up the firm, possibly because they're not ambitious enough, and they don't realise that they could become quite large. I think this probably applies to us, and that can create a lot of problems actually if you haven't sort of thought about it when you started.
Did you envision that growth from the inception, from the very beginning?
Yeah, so what we did, and I think this was a very good thing to do, although I found that quite a lot of our clients, I think somehow don't appreciate it, but anyway, what we did is we said that we're comfortable, if you like, taking on $5 billion in sort of assets under management. And that the reason we sort of get to that figure is we look at the kinds of companies we're going to be sort of likely to hold, and we say, would we have liquidity problems being able to buy those if we had $5 billion under management? And in fact, so when we first ran the firm and we only had, 100 or 200 million under management, we still made the assumption that we had $5 billion. and then we did our position sizing based on that. So now because one of the great sort of, it's a sort of trick, if you like, of fund management, and what a lot of firms do is they start with a small amount of assets, and then they buy a lot of very small cap stocks, and let's suppose they do very well, and they generate a large return, but then their assets rise, and they're not actually able then to do that again. So what we try to do is sort of say, let's really be true to our principles, assume we've got this 5 billion, and that means we can't go around buying very micro cap stocks because we would account for far too much of the turnover. And also, what happened with us then, of course, is we did get to, well, the 5 billion is a form of book value, and that will rise as the markets rise. In a sense, your opportunity set will rise with the markets. And then, but we got to that 5 billion equivalent back in about 2011. And so since then, what we've done is we only take in new assets when existing assets leave, so that we stay at the same, what we call net client contribution. And that we're not actually closed because, we will take money in when someone leaves, but we run a sort of a form of waiting list. And we've been doing that since 2011 to stay at that. So we don't, because if we had if we had 100 billion under management, it would mean we just couldn't invest in a lot of mid caps and mid-small caps, which has been a sort of, they're not the only companies we invest in, but they are certainly a sort of significant amount. Mm-hmm. So that's the sort of, the logic we followed there.
Shall we then move on to the funded model?
Yeah, sure. Well, this is more simple, but it's something I learned having kind of not done this when I was at my previous firms, which is really using sort of what the Americans or we would call pooled vehicles, which are, so effectively clients go into a pool and you have to have all the right mechanisms, so, you don't charge them excessive fees for doing that, etc. But essentially it enables you to run far more assets with a small number of vehicles in question. So at our firm, with our $13 billion, we only actually have 4 accounts, and they're all these sort of funds. And that makes sort of trading and compliance and things a lot easier. So that's the sort of, the funded approach. I mean, so yes, but I should state, we don't do sort of really retail fund management like Cobus, where
that was
I'm not
exactly,
sure.
Yeah, that was exactly one of the questions that I got before we started. How do you cater to the retail business? I was asked that question.
Well, we do take on some individuals, but all of our clients, they have to have a minimum with us of $10 million. So it's sort of
wealthy individuals.
They tend to be some wealthy individuals, exactly.
Quite wealthy. All right.
Okay.
Yes, no, keep going, please.
No, so, I mean, outsourcing is the next one. That's interesting because, when I started in the business 30 or 40 years ago, we used to, it looked a bit like one of those sort of, maybe a Chinese accounting firm or something. We had thousands of people doing effectively clerical jobs. And that obviously, with modern computing's changed that. But so, in effect, has basically the number of parties who are external to the firm who can offer you those services if you wish. and that will cover, it can cover, compliance, valuations, just about anything you like. I mean, we chose not to outsource any of our compliance or our trading or the marketing function, because we regarded those as sort of critical
core to the business.
Yeah, and that we might, it might be problematic if we were not in control of them.
Yeah, certainly.
But people. I mean, so we have an operations team of 10 people, and they are not really a sort of a back office. We regard them; they're a form of middle office between the between the analysts, below the analysts, as it were. But their job is sort of managing outsourced relationships, essentially, for us.
And do you outsource with UK providers, or you work globally with providers outside the UK?
Both. Yep. So we have used some American, outsourced providers. I
didn't mention you're based in Chicago as well. You have a.
We have an office there, but that's a marketing and client service office. But yes, so there's that, and then. So now I'm going to get sort of difficult. Yes, these are difficult subjects.
You and I didn't discuss this during our conversation, but correct me if I'm wrong. Are you going to talk about how to find a successor for Mr. Tim Anderson when you eventually retire? Right? We have your son there in the first row, but.
No. Well, no. So I was going to say, hiring is a very difficult thing, really. And we don't have any magic solutions. I mean, the thing we've tended to do, and we're lucky to be able to have to do this only, really, is we tend to hire younger people and then train them up in our style. We haven't hired more senior people, because it's can be a little bit more difficult. But then the downside with hiring young people mainly is you do have to train them, and that is intensive on time, and effectively it's an investment.
It pays off eventually. It's a long-term investment in human capital. Yes.
Succession's a real pain, and I'm afraid I'm actually going through that sort of issue because I'm 60 years old, and I would like to sort of retire in a few years' time. But of course, I will still. This is a problem. But all first-generation companies have this. One can't focus on one's own problems. But basically, I'm a sort of big shareholder in the firm. So what it potentially leaves is, I'm not in the firm as a active investor or whatever, but I am a sort of big owner of the firm, and I'm not in the firm as I am now.
Advising position, maybe.
Well, exactly, and it's a difficult thing, and we've sort of, at least we talk about it. I don't know,
which is more than most companies do.
Well, I hope so. And then
you mentioned the investor, the training program, right?
Yeah. Well, then, so
shall we invite Hugh on stage? Ladies and gentlemen, let me introduce you, Hugh Sanderson.
Thank you, Lewis.
Yes. Tell us a little bit about your investor training program, because I think that's your responsibility, right?
Yes.
Okay.
I'll just make two brief points on that. So everyone starts out as a generalist, covering multiple industries, and there's a mentorship system through which one corresponds on ideas and with weekly catch-up on investment ideas and these things. And then one sort of specializes in specific industries a bit later. So that's the sort of model that everyone's gone through. And obviously there are parts like doing one's CFA and the qualifications. And then I think the third part is the philosophy. which one learns from reading and getting an understanding. So I hope that's helpful.
Certainly. I have a question for you. I mean, how do you recruit the students or those who join eventually the investor training program? Do you use some of your interns maybe and invite them to join the program, or you scout for talent outside and bring them on?
I mean, I've been with Sanderson for about 2 years, so I'm relatively new to the business, so maybe that's a better question for Tim.
Yes, we do quite a lot of, and I'm sure Cobas does. Well, I suspect you do, of what's called sort of internships. Do you know what does that thing? So, and actually, we picked sort of 2 of the people who joined us. They started off with us as internees, and we sort of, that was a bit through like networks that we knew them. Mind you, we do a lot of internships sort of as like, slightly, to be honest, it's a favor to the people, and we probably do like 6 or 7 a year. So it's not very often that we think, because often the people, the internees are just trying to get some experience. They don't really want to come and join us.
They're not committed to a long-run process of...
Well, no.
Okay.
And we do, it's slightly difficult, and we do some, quite a lot, I don't know if you do internships, so people do them while they're at university in their vacations, and we do them, and then they can sort of put on their CV that, you know, they've worked in the fund management business, but they're not really looking for a job at that time.
I understand. Okay, thank you very much, Hugh. Shall we then talk about philosophy and process and, yes, because we've covered all these points, then investment objectives. That was the next step on the list.
I'll speed up a bit because I don't want to overrun too much on time. Yes, I mean, investment objectives is an interesting subject because, I mean, essentially what you should be trying to do for a client is to meet their liabilities. Now, the problem is that if you buy equities, over the very long term, they will meet those liabilities. But over sort of shorter periods, even 10-year periods, sometimes they don't. And, you know, I think we always try and talk to clients on the basis of sort of what they really need, you know, which is we'll try and match their needs rather than matching a benchmark per se, because they're actually slightly different, but importantly different sort of things in many ways. And, you know, so I'm actually a bit of I don't really like indexation because, partly because of that point I just made about they're not really meeting the client's requirements. And secondly, market cap-based indices can be incredibly flawed. And, you know, we've seen that time after time. So whilst I accept kind of the logic of John Bogle's points, I still think the overall concept of indexation can be very flawed.
I would like to ask you, how do you go about sort of educating your clients in the approach to investing that you follow? Because exactly that reason.
Well, what I try and tell them is that we actually have quite a high tracking error, which is a sort of deviation away from the index. And normally people might say, oh, that's risky. But in fact, if the index itself is risky, deviating from it actually is not as risky. And, you know, so I say that tracking errors are not a good proxy for risk. I think the problem is a lot of outside parties So like consultants and marketing people, they focus on your return relative to a benchmark. And, you know, they say you've done very badly or you've done very well. And that, you know, that I'm not going to change that with what I'm saying. But, you know, I think one has to sort of think, and clients need to think about what they really want, you know, or need.
Of course, of course. I just realized we skipped to tracking error because that was one of the points on the list.
No problem. I won't cover that
okay.
again.
All right. Then next up is value and quality.
Yes. Well, I'll tell you the way. I mean, we do things which is not again a sort of you know, perfect, and there are other ways of doing it. But our approach is. We're not really a big, deep value manager, so we don't buy something that's usually that's sort of very, you know, bombed out and they've got a lot of debt and problems, etc. We actually like to buy high-quality companies, but they mustn't be overpriced. I think that's the problem with the growth philosophy is you'll pay a high margin for something. We're trying to get good quality without paying an excessive amount. And in fact, if you look at our relative valuation since our inception, in fact, apart from the period when we started, which was sort of 2000, 2003, apart from that period, for the other sort of 15 years or so, our valuation of our program is pretty similar to the index, you know, a bit above, a bit below. But what's really different, and this is, I won't go through it now, but just maybe for your reference, in page 12 in this book shows you that we've actually generated a lot more underlying growth, or our companies have, in terms of their earnings, dividends, cash flows, and book value than the index. So what's actually propelled our performance actually has been that. And I think Warren Buffett somewhere talks about how value and growth are, he has a good phrase, like, you know, he's good at doing these things, is saying they're like joined at the hip. And I like that because, you know, value and growth actually aren't sort of antipathetic. They're quite, you know, growth is an integral part of a lot of good value companies. And we're also, we're a very much, again, this is the way we do things, we're very much a bottom-up firm. We don't like market timing. We think it can be very dangerous. And we don't do a lot of economic forecasting because we don't know better than anybody else, and we, you know, economists are sort of subject to the same behavioural problems as everyone else. Yes, we think there are more inefficiencies at the individual stock level, but then actually, well, as Hugh mentioned, the way we organise our research is we do it on a sectoral basis, so different analysts have responsibilities for different sectors. And, you know, our universe, as you mentioned at the beginning, is the world ex-US. So, you know, the person, Christian, who looks at automobile companies for us, he's looking at, you know, Daimler and, I don't know, Peugeot and sort of others, BMW in Europe, but he's also looking at Toyota and Nippon Denso, you know, in Japan and everywhere else. And it, you know, but we don't make decisions on a sectoral basis, but that's the way we do the coverage, because individual analysts can build up good knowledge of different industries, which is, you know, that's very helpful for particularly some sectors like, say, banking or insurance, which have complex sort of metrics that people use, you know, that it's important to understand.
I'd like to mention that the presentation book, that there are free copies for those of you who are interested in getting one, explains that, covers that in detail, somewhat, a lot of detail. Who is, you know, following which sectors, etc. Good. can we then now discuss maybe turnover,
So
right?
yes,
Okay.
absolutely. Well, our turnover, this is in the book actually, is averaged about 15% per annum. And again, we don't have a sort of target or anything, but that's how it's panned out. It's not always that, you know. Sometimes it's 25, and even at the bottom, I think we only had 5% in 1 year or something. But I think we've generally found, you know, it's on average taken sort of 6 or 7 years for an investment thesis to work out, which is what that 15% is implying. You know, some stocks we only hold for a year because they zoom up, and others, we still have some companies in the portfolio, which is in the book, which we've had since our start in 2000, which, i.e. they haven't been very successful, but you know, we're always live in hope. And yeah, so the final point, engaging with companies. This is an interesting one. I mean, there's been a lot of sort of talk that fund managers are wasting their time by meeting with companies. You know, that companies are sort of spin them.
Always try to present themselves with the best profile.
Yes, and they're very, you know, be very optimistic or something, or misleading or something. And we don't. I mean, we're a bit old-fashioned. I mean, we think we do believe in engaging with companies, and particularly actually in the mid-small area. We find that's where, well, in a way, we get more out of the meetings, and we're often quite a big shareholder in the companies. Whereas, you know, in Nestle or, you know, Daimler, we're only a very small shareholder. But I think, I mean, because what we try and do is talk to companies, and we don't sort of say, you know, what earnings are you going to make in the next quarter and all of this. We're trying to get a long-term perspective of where they're going, and management finds that a bit quite refreshing, I think, sometimes. And we're also trying to understand the corporate culture. So we often don't just meet with the chief executive and the finance director, but we try and go and visit the company on site and go and, you know, meet other people and see whether what their views, you know, are the same, reflect the same culture as the senior management, you know. So it's a sort of multi-pronged way of doing it.
I've noticed by reading your presentation book that you have quite a number of Japanese companies. Is it also a multicultural? What are the differences when you travel so far to meet the management in Japan? How do they react to Westerners inquiring about their financials, etc.?
Yes. That's a good question. I think. I think Japan and the sort of authorities in Japan have certainly been conscious for the last sort of 10 years or so that they don't. Japanese companies are often seen as rather opaque and not giving out information, and in the worst cases doing things not in the interests of sort of external shareholders. But they really want to change that because they realise that, you know, the capital markets are very important for them. So they are making progress, but, you know, it's not perfect. But we find actually Japanese companies we own, they often financially are in much better shape than those in Europe. You know, partly, I mean, and they're often actually overcapitalized, which isn't optimal, you know, but at least it's better to be overcapitalized than over-indebted. And, you know, so our experience in Japan's been good, and our stock selection in Japan has been very good in terms of adding value, so that would be...
Thank you very much. Well, we've managed to cover everything.
Great.
Excuse me. All right, so that'll be all for now for the main presentation. Now we'll open the floor for questions. Who would like to ask the first question? Yes. Yes, and second question here in the front.
Yeah. Mr. Sanderson, thank you very much for your speech. My question would be, what margin of safety you normally ask for when investing in a new company? I mean, quality investing makes all the sense, but there's always the risk of overpaying. So how do you really avoid overpaying for growth? Thank you.
Yes, what we do when we look at individual companies is we build different models that are sort of forward-looking on how we think the company might progress, and we do a sort of a central case, you know, our best case, if you like. Sorry, our base case, and then we do an optimistic case, and then we do a pessimistic case. And the pessimistic case is very useful because it sort of shows you this is what might happen if certain things become more adverse than we had thought, like maybe, you know, exchange rates or interest rates or something. How sensitive is a company to that? And if you get an answer that company is very sensitive to changes in a few variables, it's a very good risk sort of system. And your point on not overpaying, that's a good one. I mean, I think that we lay a lot of emphasis on when we look at the company's quality, it revolves around looking at the industry it operates in, its own competitive position, its finances, etc., so that hopefully we're getting it's a high quality business, you know, in a variety of different ways, and thus less likely. And we won't pay more than the index valuation on the whole for it. So, you know, it's, we're confident that, the downside is somewhat limited. I mean, you know, we do have failures, and when those quality characteristics I mentioned are very important, because if we buy a company and then we find out that the quality we thought it had is impaired or, you know, goes away, we'll actually sell the stock irrespective of the price. So that way we sort of hopefully avoid, you know, because you know, it's not negotiable for us, the quality, in a sense.
Thank you for the question. There was a second question here in the front. Yes. Oh, okay. Ren, then you'll go next. Okay.
I'm surprised seeing at your portfolio that you have so many well-known, big quality companies. Does the market normally underpay for quality? How can you get such good outperformance having such big companies that everyone knows about?
Yeah, you're right. At the moment we have more larger cap names than we have tended to have. But that's because actually over the last 10 or so years, the mid and mid-small cap areas outperformed quite a lot. But yes, as I said, I mean, our record is that the companies we've bought have delivered more in terms of, you know, underlying earnings, dividends, book value, actually to the tune of about 5% per annum. And that is what has driven, so if you look at our performance record since inception, it's about 5% per annum above the index, and that's actually how it's come.
Thank you. Next question, please.
Okay, thank you, Mr. Sanderson. And my question is quite different from the audience. So the first thing is, why history? Why so many people in your company have studied history? And in terms of philosophy, what do you think it's the role of the studies of a person in him or career? So because I'm actually a student and I don't have $10 million, so my question is in this direction. Thank you.
So on why we have people who've done history.
First, you, if
yes, no. Well, no. History's interesting because I think it's it's quite an analogous discipline to investment in that you have to sort of read lots of sort of papers and then try and reach a conclusion, and you have to be, in history, one of the biggest problems is that the documents you read, the source material, it can be flawed, or someone can have written something, exactly, it's not true, but, he wrote this and you mustn't believe that, So I think that discipline, fun enough, is sort of quite analogous to investing in companies. And also, I mean, to be honest, history is an interesting subject. And, I think actually a lot of investment, Hugh can maybe talk about this, people read about past periods of investment, and so if you read Warren Buffett or something, he actually always talking about what happened at this time and that time, and it's learning from those lessons, is very important. But it's also interesting. I mean, I think it stays with you as a subject, but I think it has some relevance. But I think all maybe we are biased in hiring historians, but it would equally be useful to have people who've done Shakespeare or something. I think there are lots of academic disciplines
But
are
that's
useful.
still in the humanities.
Yes, I mean, or if you've done, well, I don't know, I'm a bit biased. I'm not sure economics is like a proper subject, but that I'm very biased. Statistics is quite useful as well, actually.
It's funny that you said that history is so important and then you forget about the track record. So it's the two sides of the same coin. So it's just a joke.
Yes, there's one more question next to the gentleman, and then in the middle of the room. Yes, then we'll get to you later.
Good evening. So I was looking at your presentation book, and in the stage 3 of your investment process, it talks about discounted dividend model.
Yes.
So would you be able to tell us a bit more about that? And another question, if I may. In your portfolio holdings, you have quite a few positions in pharmaceuticals.
Yes.
So could you tell us a bit more about moats in pharmaceuticals other than, patents that they may have? So.
Well, as I said, we have different analysts who cover sectors, so I can always use the excuse. I say I don't cover pharmaceuticals, which I don't. But I think actually that's been a very difficult sector for quite a few years now, and we feel that there are issues there to do with drug pricing and developing. Some companies have found it difficult to develop new drugs, and that's an issue, for example, for Glaxo. But we think things have come down to a level that they're quite attractive. We're not actually. If you look at, there's a later slide in the presentation which shows our exposure by sectors, and we're sort of about. I think we're still a bit underweight. It's called healthcare in pharmaceuticals and healthcare related things. Yes, and sorry on the DDM. That was what I referred to on the question. The gentleman back there was asking about how we try and look at the risks of companies. I said we do a base case and a best optimistic case and a pessimistic case, and that we use a dividend discount model for that. And the discount rate to that is 5% real, 5% plus inflation in the for each company, and that actually is the level over the long run. If you look at stock markets, obviously those studies done by Paul Marsh and people, they show that stock markets do deliver about 5% real, you know, give or take a little bit, plus or minus. But so we're using that as a sort of a proxy for, you know, our discount rates.
Good. Thank you for your question. Another one in the middle of the room.
Could you tell us how is your portfolio committee organized? Many members. How do you make the decision? How is the decision making?
Yes, that's a good question. So as I mentioned, all the analysts have their own sort of sectors that they look at, and in fact, it's an aspect of the firm I didn't really cover, but I think our business is slightly unusual, maybe, in that doing all that work is quite solitary. So people are off, you know. No, they go and see companies, but they're kind of working on stuff. You know, it's quite an academic kind of approach, and they're doing it on their own. But then what we do is, and that's one of the reasons why all our fund managers are in London, although they're looking at global companies, is that we can all get together, and we all meet, and we discuss what new research has been produced, and then what stocks we ought to be buying and selling. You know, we have and then we have 3 sort of monthly meetings, 3 meetings each month. So one covers the screens we do, which highlight stocks that look potentially interesting. The second covers, we review new research work we've done and work on existing companies. And the third one is implementation, when we discuss what stocks, if we're going to buy new stocks or sell stocks, or whether we're going to add to things or sell things. But as I said, our turnover's 15% or so is not, we're not like a hedge fund, you know, doing some massive trading.
I will now read a question that we just received from one of our viewers on YouTube. He mentions overweight in financials. Yes. So what value do you see in banks? And he asks, can you give us a name?
Yes, that's a good question. One of the, I always prefer to talk about the past than the present. Maybe it's been because I'm a historian. But we did well in a relative sense in the crisis of 08, 09. And that was because we were very low in financials, and sort of going into the crisis, you know, financials were highly priced, and actually they were incredibly leveraged, as everyone knows, although it wasn't completely obvious, but they were, take it from me. Now we've got into the sort of opposite position of, you know, the regulators have made financial companies, in particular banks, you know, hold far more capital, and there are sort of all these rules on liquidity and that kind of thing, which has made the system really a lot safer, but it obviously means that the potential returns you can make on a bank when they have a much higher capital base is going to be necessarily quite a lot lower. So, you know, most banks will struggle to make more than sort of 10 to 12% per annum, given their current, you know, larger equity bases. Whereas before the crisis, you know, they were reporting 20%, etc. ROEs, but they were dangerously undercapitalized, and they're not now. So we think it's a much better sort of risk-reward quotient for the banks. We have quite a lot of insurers and a few sort of, and other sort of financials. That's a different sort of, the dynamics of those industries are different. But specifically the banks, I mean, we have Lloyds Bank in the UK, and then so HSBC and Standard Chartered, whilst they're not really British entities in terms of their business, or not, it's not a significant part. We do have those as well, and we think that they look attractive because partly because Brexit meant that the pound fell, particularly against the euro, and yeah, they're on price to books of less than 1.5, you know, which and some of them are below book value, like Standard Chartered, which is historically, low. So.
And another question from YouTube. This viewer asks, if track and error is not an appropriate measure of risk, what would you say, what in your opinion would be a valid one?
That's a very good question. Well, the risk in investments we see is kind of losing all your money. I mean, not all of your money, but in a stock, So, and that can come. Well, I think yes. One of the dangers is I talked about growth, but growth investing where you're paying very high multiples for things. The danger is, if for some reason that growth slips or indeed goes away, and then the multiple correction that you're going to have is absolutely enormous. And that, that happened to a lot of the high-tech stocks in that period, 2000 to 2002. I mean, also a lot of them were actually very shoddy businesses, but anyway. So we think it's sort of to do with, not losing too much money in something is, and one of the keys to that is not overpaying. But I think the second thing, as I mentioned, we talked about is sort of being, testing that quality and being confident that the quality is, is as you perceive it.
Thank you. There was a couple more questions. Yes.
Thank you for the presentation. It was very interesting. I noticed in the book that through the years you have reduced the number of portfolios, even though if you grown your assets by quite a bit. Could you give some insights why this concentration of vehicles or strategies?
Could you repeat the question, please?
Sorry, I didn't hear.
Here in one of the charts of the book, it seems that you reduced the number of portfolios from 17 to now 7, even though you've grown your assets by more than double or triple, and maybe.
Yes. Well, the number of stocks we've held has actually been pretty constant between 60 and 70. And it goes back to what I was saying about, in the first part of my talk about, the size of assets you have under management and sort of thinking about that when you start the business. Because because we assumed we had 5 billion under management at the beginning, that meant we had, quite a lot of stocks, but if we just we could have bought, as I said, 10 very small cap stocks, because we only had 100 million to start with, and generate a very good return, but that wouldn't have been, replicable. Whereas we think our approach, demonstrates that the company's capable of delivering these returns, even if it's substantially bigger. So I think that's a really important point. But I find clients, they didn't seem to worry about it too much. But but I think it's crucial sort of understanding your size, because otherwise you can just get forced out of your normal investment area by the assets you have under management, unless you constrain those assets very considerably, which some people do. People doing mid or small cap programs. There's a guy in the Silchester School he just does small cap, global small cap, and he only took $1 billion. That's what his cap is.
One of our viewers from home was asking about concentrating your portfolio. Is there a magic number of companies to hold? So.
Well, yeah, it's a good question. I mean, we found we tended to grow because the number of stocks we used to hold tend to grow because often we couldn't hold large positions in smaller cap stocks. So we kind of developed a bit of a tail on the program, of these sort of smaller positions, which are still, useful. They generally did well for us. I think there is mathematics that show that if you have more than about 15 stocks, even in globally, that you've reduced your beta to sort of something like, well, it depends the individual stocks you hold, but the beta reduction is very substantial after you hold about 7 or 8, and then it gets to about 15 or 20 holdings, and you don't get much more statistical diversification beyond that.
Thank you. Question in the back.
Hello, Mr. Sanderson. Just first of all, a comment. I see on your portfolio that you are holding Acerinox shares from Spain. I just wanted to make the comment. I am an employee of Acerinox, so thank you for your trust in us.
Very good.
So coming back to your portfolio, I see number 1 is a financial company from China. You also mentioned HSBC and Stanchart that are very focused on Asia.
Yes.
Are you worried about China? I mean, the high level of debt, the leveraging that is occurring in HNA or Wanda, the figures that are published that apparently are not that accurate, that maybe the GDP is not as they said it was. Are you worried that something is going to happen there or not?
Yes, that's a very good question. China's, I'm not a fixed income expert, but strangely enough, we did have a discussion among the Silchester affiliates that I mentioned, and there was a person from they do fixed income, and they talked about China's debt, and it's clearly like growing at an unsustainable rate. But the problem is, so is the debt in the West. So, I'm not sure they're any worse off than us. And and it's interesting, actually, you mentioned Ping An, the insurance company, because that, in fact, insurance is very good business in China, because there's still quite low penetration, and they're still growing very fast. It's been an excellent investment for us, but we still think it's reasonably attractive because of that. But China has announced measures. They haven't implemented them yet, and they're going to do that slowly. It's quite sort of typical in a way, but they're going to liberalize their financial system quite a lot, and it's a bit of a threat for Ping An, actually, potentially, because at the moment, no foreign financial entity can operate in China, except via the maximum you can have is a 20% stake. And in fact, it's interesting on Ping An. I don't know if you know this, but HSBC used to own 20% of it, and this is how I got to know the company. Because HSBC helped them set up all their systems and all this kind of thing. And then I think HSBC felt that that the government of China had indicated that, they'd be allowed to take a bigger share of the company. And then basically the Chinese said, well, no, you can't have any more. And HSBC were really annoyed and they sold out. But, that's just the sort of the history of it. But otherwise on China, it's a sort of enigma wrapped up in a riddle, or whatever Churchill said. I think that was a Russian, he said it. But anyway, you understand what I mean. And yeah, the debt is a problem. And also, the thing is, China's quite regional. That's the other thing to understand. And on the East Coast, where they have a lot of the manufacturing's been, they already actually have problems with labor shortages, which is amazing, But if you go to Western China, so inland, away from the sea, it's much, much poorer, and they have huge amounts of labor that's sort of spare. So it's a sort of unbalanced sort of system. But we're very struck. So some of our Japanese companies, they actually sell equipment to China. And these companies like Keyence and Fanuc, they sell very, very high quality equipment, industrial equipment and robotics and stuff like that. And China's a big buyer of that sort of equipment, which is kind of a bit surprising. And it shows you that they're doing a sort of technology leapfrog, and they're jumping to a really high level of sort of industrial sophistication, much higher than you'd kind of think. But of course, that's partly because they're worried with these labor shortages. You know, labor rates are going up so much that it's worth their while, you know, developing in very high technology equipment. I'm sorry I rambled rather a lot on that.
No. It was very good. Your answer was very good. One more question, yes.
Tim, closer to home, it looks like you are overweight the UK. Can you give? I mean, you are homesick, or you're fond of the empire, or can you give us some color on the country, and how do you see your country in the next 100 years?
Yeah. Oh, I was. Yes, I better make sure of my facts before I answer you. Yeah, the UK, maybe a bit unsurprisingly, is in terms of the stock markets and really the economy. Actually, it's like very two-tiered, and basically the export side is actually quite strong. And that, you know, is not surprisingly because of the Brexit vote, the pound fell a lot, and there are a lot of British companies which they either export quite a lot or they have overseas subsidiaries, and then when they translate back those profits, they basically go up. You know, gone up a lot. Now the pound actually has recovered quite a lot against the dollar, but not very much against the euro. So it's still, you know, that's still basically a positive thing for a lot of British companies. And in fact, if you look, what's interesting, our exposure to the UK is about 25%. Of our program, but separately we do an analysis which shows how much of that is generated from overseas, and it's actually it's 12.5%. So exactly, so half of that 25% is either from exports or from foreign subsidiaries. Then the other half of the UK economy is the domestic side, which would be, you know, things like retail, some of the banks like Lloyd's, and leisure, restaurants, that kind of thing. And that area, I mean, retail is having a very, very tough time in the UK, but I don't think it's all because of Brexit, really. I think it's just retail's undergoing a lot of changes, and that is hitting a lot of retail companies. But, you know, the UK domestic demand is, well, it's growing not very much, growing about 1% per annum. So, I mean, you can look at Brexit didn't cause a recession. Well, the Brexit vote didn't cause a recession, I'll rephrase that. But that's partly because, as I said, the fall in the pound is really quite positive. Is Brexit going to lead to a recession going forward? That is a moot point. I mean, you know, recessions themselves are not a disaster. I think we think that it could be quite difficult. Probably more important than Brexit is actually political instability, not to do with Brexit really, but with, you know, politics. And if we get the current opposition in the UK is like incredibly left wing, and it's surprising after the UK was such a, you know, under Mrs. Thatcher and others, was sort of generally more seen almost as structurally more right wing than Europe. We could actually go to the opposite of being sort of more left wing, which is quite a thought. But I don't think I don't know on that, and the markets don't. The markets do not seem to be too worried about it. That doesn't mean to say it's not a worry, but just as it is.
Okay, I would like to maybe change subjects a bit to finish with. I showed you and I explained to you that we publish books. Is there any title you would recommend to somebody who would like to start learning about investing? You mentioned, you praised Benjamin Graham's writing style while I was showing you our library. For any particular reason, do you happen to enjoy that book? It's already in Spanish, by the way, but...
Well, the Ben Graham, is it the Intelligent? Yes, it's a brilliant book. I mean, actually, Ben Graham, I think I'm right. I mean, he wasn't actually, as a practitioner, a brilliant investor, but he was a brilliant writer about investment, which is a slightly is a different thing. But there's no one, I think those images he creates, like, you know, of Mr. Market, you know, and then I meant to mention one when I showed there's those charts of how we've added more in terms of earnings and dividends and things. And Ben Graham made a great comment saying, in the short run, the market is a voting machine. But in the long run, it's a weighing machine. And that's so good, you know, and true. But the end of the book I really like, because he was a very clear writer, and he was actually very original in some ways, certainly for the time when he was writing, is Philip Fisher's, you know, Common Stocks and Uncommon Profits, because it's, again, there's some cracking stuff in it, and you know, he was, it's very interesting because he wrote about it. You see, he started like in the early 30s, and in the investment business, and that was he said it was like weeks would go by before he had any client meetings, because everyone, you know, after the Wall Street crash, everyone hated equities or investments. But that gave him the time to work out, you know, he does those fantastic bits about how to interview companies and things to look for in balance sheets. And they're, you know, although it was written, you know, 60 or 70 years ago, it's still so appropriate.
Well, we'll make a mental note to present that book eventually here at Value School. We have book presentations every month, at least one. Thank you for the recommendation, and thank you, Mr. Sanderson, Tim, Hugh, for being with us here tonight. Thank you for your words of wisdom, and thank you, everyone, for your excellent questions. And I'm going to say a few words in Spanish for those watching from home.
Next week, we will have Professor Maria Blanco talking to us about savings, investment, and economy from the angle of the Austrian school. And this will be the wrap-up for the Austrian school theme that we have covered in February. And at the back of the room, they're telling me that we have a corner for our followers. We have a corner in our blog where we'll post the articles that you submit to us. So we encourage you to start writing and submit your works to us. Thank you very much, everybody, for those of you here in the room and for those of you who saw us from the comfort of your rooms. And see you next week at Value School. Thank you very much, and good evening.